An IRA conversion, where you convert a traditional IRA to a Roth IRA, is not subject to income limits. In most cases, the conversion is a fairly simple two-step process. First, establish a traditional IRA and contribute funds to it. Then, at some later date, instruct your IRA manager to convert either the entire account or some portion of it into a Roth IRA. Now, if you claimed a tax deduction for your contributions to the traditional IRA, you will need to pay federal income tax on those contributions at the time of the conversion. Depending on the size of those past contributions, the resulting tax hit could be substantial. Therefore, if possible, it's best to convert an IRA during a year when your income and tax liability are lower than usual. In the past, it was possible to undo a Roth IRA conversion through a process called recharacterization. However, in 2017, Congress outlawed recharacterizations for conversions occurring in 2018 or later. Considering both the potential short-term tax impacts and the irreversibility of the transaction, an IRA conversion requires careful analysis and planning. We'd be happy to speak with you about whether a conversion makes sense for you. IRAs were created as vehicles to provide taxpayers with retirement security, not as general-purpose savings accounts. Therefore, withdrawals taken from an IRA in your younger years may trigger IRS penalties. In general, you must be at least 59.5 years old to take distributions from your traditional IRA without penalty. After that age, you may take as many distributions as you wish from the account as long as you pay any tax due on them. The early withdrawal rules for a Roth IRA are more forgiving, since you do not defer tax on your contributions to the account. In many cases, you may withdraw funds that have been in your Roth IRA for at least 5 years without penalty, even if you are younger than 59.5. Special rules exist for distributions taken due to certain hardships or financial emergencies. If you find yourself needing to draw upon your IRA funds during a time of struggle, we can help you determine whether you qualify for a waiver of early withdrawal penalties. There is no magic formula to determine whether a traditional or Roth IRA will serve you better over the long haul. Nor is it strictly an either-or choice. IRS rules allow taxpayers to maintain multiple IRAs, so many people hold both a traditional and a Roth account. Remember that if you qualify to contribute to both types of IRAs and to deduct your traditional IRA contributions, the primary difference lies in when the money is taxed. With a traditional IRA, funds are taxed when you withdraw them as distributions, including RMDs. That is, your money is taxed when it comes out of the account. With a Roth IRA, federal income tax applies to your contributions, so the money is taxed when it goes into the account. Later withdrawals, provided they are not subject to early withdrawal penalties, may be taken tax-free. Remember also that Roth accounts generally do not have RMDs. These general facts suggest a couple questions to consider as you develop your IRA strategy. Do you anticipate your income in retirement being lower than during your working career? If so, then you might benefit from the back-end taxation structure of a traditional IRA, since your retirement income may be taxed at a lower rate than you currently pay. Do you expect to depend on income from your IRA in retirement? If not, you may want the greater flexibility and ongoing tax-free growth offered by a Roth IRA. With no RMDs to satisfy, you can take tax-free distributions only when the need arises, or simply when you feel like splurging for a big-ticket item or major vacation. These are only two of many data points to consider. Ultimately, each person's situation is unique, so we would be happy to meet with you and discuss your circumstances and goals. All IRAs are subject to annual contribution limits, which are set by Congress and adjusted over time for inflation. Note that the IRA contribution limit applies per year, not per account. So if you have multiple IRAs, the total of all your contributions must not exceed the limit. If you contribute more than the limit to your IRAs, the accounts may lose their tax advantage status. Therefore, you should always check the current limit before setting up your contributions for a given year. So that's a general overview of IRA types and the different tax advantages they offer. If you have any questions or would like to learn more, please get in touch by calling or filling out the contact form. It will be a pleasure speaking with you about your unique circumstances and needs.